Hi there, I'm Edward Kalstian, founder of EKH Capital, where we look for market-beating stocks for the long run. Today, we're breaking down ONON Holding, the Swiss premium performance brand behind the distinctive cloud tech running shoes and apparel line. Founded in Zurich and backed early on by Roger Federer, ONON has become one of the fastest growing names in athletic footwear, competing directly with Nike, Adidas and Lululemon. We are going to break down ONON stock using our 5 key factors to determine whether it's undervalued, fairly valued or overvalued. We look for high returns on capital, strong growth, healthy financials, an undervaluation and a sustainable moat. If you find this helpful, be sure to like and subscribe. Now let's jump in. Great businesses start with efficiency. If a company can't earn strong returns, nothing else matters. Looking first at return on invested capital, ONON posts 19.9%, ahead of Adidas at 8.4%, but below Nike at 29% and Lululemon at 40.4%. Next up, return on equity. ONON's 19.6% sits between Adidas at 14.2% and Nike at 40.1%, while Lululemon again leads with 42.4%. These are solid efficiency metrics for a young, scaling brand, well above Adidas, but still far from the industry leaders. This shows ONON has built strong operational returns early, though sustaining them as it scales will be key. Returns are decent, but without growth, the compounding machine stalls. From 2021 through 2024, revenue grew at a CAGR of 47.6%, one of the fastest in the sector. Net income CAGR isn't meaningful since 2021 showed a loss of roughly $0.2 billion, but profitability has improved sharply since. Now continuing to earnings per share. If we take out 2021, which showed a loss, earnings per share grew at a compounded annual growth rate of 104%, an incredible acceleration as ONON scaled globally and expanded margins. That said, triple-digit earnings per share growth won't continue forever. The key question is, how much of that momentum is already priced into the stock? Even the strongest business models can crumble under weak balance sheets. Let's see where ONON stands. Cash and short-term investments sit at $1.1 billion, total debt at $0.4 billion, which results in a net cash position of $0.7 billion. The debt-to-equity ratio is at 0.4, comfortably below 1. Free cash flow for fiscal year ending 2024 was $0.5 billion versus $0.4 billion in total debt. These numbers show a very healthy balance sheet. ONON easily covers debt with cash and leverage is minimal. Even as of June 2025, cash and debt levels remain stable, underscoring strong financial flexibility. Even great companies can make poor investments when investors overpay. So how is ONON valued today? ONON trades at a price-to-earnings ratio of 84. Looking at peers, Nike is at 35, Adidas at 28.3 and Lululemon at 11.8. Now let's adjust the price-to-earnings ratio for growth using the PEG ratio. With analyst long-term earnings per share growth forecasts of 23%, we get a PEG ratio of 3.65. That's very steep. It means the stock is priced as if the recent 104% earnings per share growth will continue in the future. An aggressive assumption for a company now operating at global scale. Even great brands can be overvalued when expectations run too far ahead of fundamentals. Does ONON have a moat strong enough to justify this premium? ONON's moat rests on Swiss-engineered product innovation, led by its patented cloud tech cushioning system and premium brand positioning in performance running. Its design and technology create a distinct consumer experience and strong community loyalty. However, compared to Nike, Adidas and Lululemon, ONON still lacks scale, diversification and marketing reach. ONON has a credible but still developing moat. Built on innovation and branding, rather than entrenched global dominance. Now before we wrap up, the detailed financial charts in this video were powered by Fiscal, my go-to investment research platform. Use my affiliate link below for 15% off to level up your stock research at no extra cost to you. In my view, ON Holding appears overvalued based on our 5 key factors. ON has strong returns on capital early on, but still behind Nike and Lululemon. ON shows explosive revenue and earnings per share growth, but it's unsustainable at 100% plus levels. ON has an excellent balance sheet with net cash and solid free cash flow. ON is trading at 84x earnings and a PEG ratio of 3.65. Pricing in very high future growth. ON is innovative and positioned as a premium brand, but its moat is still relatively narrow compared to the global leaders. ON Holding is a phenomenal growth story with the potential to sustain profitable expansion. However, at today's valuation, much of that optimism already seems priced in. The business looks strong, but the stock, at current levels, appears overvalued relative to fundamentals. What's your take on ON Holding? Drop a comment, hit like and subscribe, and let me know which stock you'd like me to cover next. Thanks for watching, and I'll see you in the next one.